Hello and welcome to another edition of the William Buck CPE program. I'm Baron and this is Kat, and today we'll be taking you through the R&D Tax Incentive program and debunking some common myths and misconceptions we see along the way.
So the R&D Tax Incentive program is designed to offer maximum assistance to startups as well as small and medium-sized companies by helping with cash flow so that our clients can continue to grow and innovate. It is designed to encourage companies to take risk without being restrained by the prospect of an unsuccessful outcome. The program isn't limited to any particular industry, so eligible companies from any industry can apply, including the IT and software development sector. The program is jointly administered by Oz Industry, who oversees the eligibility of the R&D activities, and the ATO, whose domain is the R&D expenditure. Eligible entities that can apply are companies and public trading trusts. All other trusts, sole traders, partnerships, not-for-profits are unfortunately not eligible to apply. And finally, the program provides R&D benefits for companies spending at least $20K on R&D expenditure, with the top threshold being $150 million.
So, a common misconception about the R&D tax incentive is that it is a grant. We often hear the program being referred to as a grant program, but it is actually quite different to a government grant, which is usually a lump sum cash injection by the government to fund a specific project that provides benefits to the Australian economy in some shape or form.
In contrast, the R&D tax incentive is actually a tax offset, meaning it can be offset against a company's tax bill and in some cases become a cash refund. Which benefit a company receives will depend on the company's global aggregated turnover. The current benefit available to companies with a turnover below 20 million is a 43.5% refundable R&D tax offset. The word refundable is important here, as it is only companies in this category that can potentially receive a cash refund if their R&D tax offset outweighs any tax due to the ATO. For example, if a client spent $1 million on R&D activities and did not have any tax payable and instead had sufficient tax losses, it could potentially receive a cash refund of up to $435,000, which is a sizable cash injection back into the company. On the other hand, companies with aggregated turnovers above 20 million can only access the non-refundable R&D tax offset as it implies. This benefit cannot be refunded, so it is only ever to be used to offset tax payable. And if there is no tax payable, it can be carried forward. The R&D rate for this category is calculated differently using an R&D intensity rate, which is ultimately the proportion of R&D spent over total company expenses. The benefit is greater for companies with a higher R&D intensity rate, essentially rewarding those who direct a high proportion of total company spend to R&D and furthering innovation.
Another common misconception we come across very often is assuming that an R&D claim is eligible because a company has successfully received its R&D benefit. It's important to note that this is not the case.
Yeah, the R&D Tax Incentive program is a self-assessment program, meaning the two departments who administer the R&D Tax Incentive, the Australian Taxation Office and Oz Industry, assume you've completed your R&D application and schedule in good faith and automatically accept the information you've provided as being true and correct, similar to lodging your personal tax return. Therefore, in most cases, you will receive the R&D refund before a government officer has assessed the eligibility of your claim, meaning the receipt of your R&D refund is not actually recognition of your claim's quality or eligibility. As part of this self-assessment process, two main documents need to be prepared and lodged as part of the R&D claim. First, the R&D application. This details the R&D activities in a written form, covering all the aspects of core and supporting activities we will discuss. Companies must register their R&D activities with Oz Industry via the R&D Tax Incentive customer portal within 10 months of the company's financial year end. Generally, this means a due date of 30 April for companies with a 30 June year end. Once the R&D application has been submitted, the company will receive a notice of registration, which is an acknowledgement that the activities have been registered, but not that they are eligible or successful, which is a common misconception. The notice of registration includes an innovation number, which is how the R&D expenditure will be connected to the registered activities when you lodge your income tax return. The R&D expenditure itself is disclosed in a separate document called the R&D schedule. This allocates the company's R&D spend across different categories, such as salaries, contractors, decline in value of assets, etc., and discloses the company's turnover. The innovation number received from Oz Industry must be included in this document to tie the expenditure back to the registered activities. The document is then submitted with the company's income tax return.
So this one's another common trap that we've come across in many industries, but mostly in software development R&D claims, where companies assume all aspects of a development project are relevant to the R&D incentive because they're producing something new or innovative as a result.
Yeah, unfortunately, we frequently see claims in which a company has included whole projects or developments where only one activity within the total project meets the eligibility requirements. This is especially true for software development projects that follow the agile style development lifecycle, as this development style already mimics a systematic progression of work. To determine what activities within a project are eligible, applicants must assess whether they meet the requirements of an R&D activity. In these circumstances, the tax law defines an R&D activity as either a core R&D activity or a supporting R&D activity. We'll go through the eligibility criteria for core R&D activity in the next few slides. However, in general, it consists of an experimental process that follows a systematic progression of work as depicted in the yellow boxes in this diagram. This means they need to be centered around a scientific experimental process based on the principles of established science such as physics, and proceed from a hypothesis to experimentation to observation, where results are recorded and used to formulate logical conclusions. Supporting activities depicted in the blue boxes are those that do not qualify as core R&D activities but are still required to undertake the core R&D activities. These can be activities such as the initial research and conceptualization required before setting out on a new project or process. It can also include project management tasks and procurement of supplies required to undertake the R&D.
So what sort of activities could qualify as experimental R&D activities? We've included a number of examples on this slide, but essentially developing new or improved products and processes, testing new applications for existing products and processes, or undertaking any field testing of products and processes outside of the lab or workshop environment could all potentially qualify as R&D activities, as long as the company intended to produce new knowledge along the way and the company followed a systematic progression of work to overcome a technical uncertainty. So how do you know if the products, processes, or services developed by your clients could qualify for the R&D tax incentive? When determining whether an activity is a core R&D activity or not, we need to consider the eligibility criteria as provided by the R&D tax law. So the first thing you'll need to consider is, was an experimental process employed? What's important when determining eligibility for R&D is the process that is undertaken to develop the single-serve wine glasses that we're using as an example here. So, for example, a hypothesis would have needed to be set around the specific filling process and seal type that could effectively store this single-serve wine for a shelf life of 24 months. Experiments around this could have involved testing different types of sealing methods and then observing how these sealing methods stood up when the glasses were filled. Did the wine leak? Did it become oxidized? Or did everything go as planned? This would then allow a conclusion to be formed. Either the predicted hypothesis is true or false. The second thing to consider is whether the outcomes of the experimental activities were unknown in advance based on existing knowledge. Each core R&D activity must have technical uncertainties present that can only be resolved through a process of experimentation. So in the case of these wine glasses, one unknown could have been whether the wine could be poured into the glass with a purposefully designed nozzle and bellow to ensure that the dissolved oxygen in the wine and the oxygen in the headspace, which is the gap between the seal and the wine, is less than a certain amount, as excess oxygen can cause premature spoilage and therefore impact the shelf life that needed to be achieved for the product to be commercially viable. It's important to note that for R&D, challenges or uncertainties must relate to technological uncertainties and not commercial risk. So commercial risks can be customer adoption or the usability of a product or application. These risks are unfortunately not relevant to the systematic progression of work required for an eligible R&D activity.
So the next question is whether the purpose of the experiments was undertaken to generate new knowledge. So in the case of the wine glasses, the new knowledge would be around the design of the filling nozzle and bellows, how they are attached to the filling line, as well as the new filling process being developed. However, if a company is using existing knowledge available to solve technical uncertainties, then it's unlikely to qualify. But it's important to note that although another company may have already developed, for example, their own line of single-serve wine glasses, clients can still claim R&D on a similar development if they don't have access to that knowledge or IP, mainly because it may be proprietary information that's not out in the public domain and not readily attainable. Therefore, in this case, companies may still undertake eligible experimentation to develop the products, even though it already exists. Lastly, R&D claimants and their advisors need to consider whether sufficient supporting documentation has been kept on file to substantiate their R&D activities and associated expenditure. This can include reports, search engine screenshots, emails, meeting reports, logbooks, receipts, and even timesheets, for example.
So the last misconception we'll cover in this session relates to the calculation of R&D expenditure. This is a common mistake we see in self-prepared R&D claims, where apportionment rates for allocating company overheads and indirect R&D expenditure are calculated incorrectly because the expenses included are either ineligible or just not relevant.
Yeah, once a claimant has identified what activities can qualify, they then need to determine what expenditure was incurred on those activities. Examples of eligible R&D expenditure include the salary and wages of Australian staff, and it's a good idea to keep timesheets with narrations or diary entries to track and substantiate these costs, and even job descriptions for each employee. Contractor fees that are based in Australia are eligible, so keep records of contracts and invoices with notes on what they were for. You can also claim a portion of direct costs, such as expensed equipment, testing kits, and materials or parts used in the development process, such as when building an experimental prototype. Overheads such as rent, electricity, internet, hosting costs, etc. These all need to be apportioned to separate R&D usage from general business usage, so it's important to be able to justify how these allocations have been calculated. Depreciation of tangible assets, so assets that have been capitalized in your books for tax. These could be computers, servers, and other hardware used in the R&D process. Intangible assets like software licenses can also be claimed if they have a direct connection to the R&D activities. Generally not eligible to claim are costs that businesses will incur regardless of whether it's conducting R&D, such as administrative fees, accounting costs, interest charged, asset registration, bank fees, etc. This also includes commercial and business development or internal costs, such as marketing, brand design, gifts and donations, and entertainment such as meals or Christmas parties. We are often asked if sweat equity or share payments or options can be claimed. The answer is no, because no expenditure has been incurred. Core technology, so the cost of technology that you have purchased or licensed for the purpose of developing it further. However, the costs associated with further developing the core technology in the experiments may still be eligible if the relevant criteria are met. If the expenditure is not at risk, for example, because the company was going to be reimbursed for the entirety of the R&D spend, then it can't be claimed. And lastly, overseas costs. These are ineligible unless the company has applied for an overseas finding and has been given formal approval to claim overseas expenditure.
And that brings us to the end of today's presentation. Thanks for tuning in, and we look forward to bringing you more content in the next edition of the William Buck CPE program.